and welcome to our ongoing pre-budget economy special, The Growth Deficit Balance. Ultimately, the budget is an accounting statement where the expenses can't be more than the income by more than, say, 3 to 3.2% of the GDP. Yet, whether a budget is good or bad depends on what the economists' verdict is. How much of a deficit is defensible to justify a growth stimulus? What will be the positive and negative effect of a higher deficit and the positive effect of a lower deficit? And thirdly, what are credible numbers when it comes to assumptions of, say, GDP growth or tax growth? These are some of the questions to which we will seek answers today with a bunch of A1 economists and interest rate specialists. I have with me Chetan Ahya, Global Co-Head of Economics and Chief Asia Economist, Morgan Stanley; Hitendra Dave, Managing Director and Head of Global Banking and Markets at HSBC India; and Sonal Verma, Managing Director and Chief India Economist at Nomura. Gentlemen and lady, welcome. Well, just a word more between me and my viewers. What economists tell me they normally do is they first assume what is the nominal GDP growth, that is GDP plus inflation growth, and then try to arrive at other numbers. So let me start first with that question. Sonal, for FY19, what is a good GDP growth to assume for the budget?
Well, for the budget, Latha, we are expecting both real GDP as well as the average inflation, the GDP deflators, to be higher. Our expectation for nominal GDP growth assumption, and I would say a credible assumption this time around, would be a nominal GDP growth of around 11.5%. Our expectation for real growth is that it's going to pick up to between 7.5% in FY19, and on an average, WPI and CPI inflation weighted average, we think also will be between 4.5% to 5%. So I think vis-a-vis FY18, where actually we've had advanced estimate nominal GDP growth of 9.5%, 11.5%, would be a reasonable assumption.
Okay. Your thoughts, Chetan? Therefore, what will be the overall GDP number look like? I mean, what is your assumption of nominal GDP for FY18 itself? I mean, after all, it has been brought down by the CSO. So should we say that now our GDP is what, 165 lakh crore? What will it become, you think?
So, no, I agree with Sonal's numbers. We expect it to be around 11.5% to 12%, depending upon inflation. So I think that's the uncertain part of it. And also that we do think that there's upside risk to these numbers generally, because we are getting actually at the margin from the global side a strong upside in trade numbers, which is what is sending upside risk to all the Asian countries, including India. So we would say that, 11.5%, 12% nominal GDP growth number, if the government shows while they are talking about the budget, it will be a credible number, Latha.
Okay. Well, then, Chetan, the next obvious question is, therefore, what is a deficit number you're working with and a market borrowing number you're working with?
So we are operating with a deficit of 3.5% right now. We do think that they will need to show higher deficit because there will be an increase in expenditure growth in the coming financial year, because it's a pre-election year. Now, there's a possibility that they may show lower than that. We've seen that change in tack by the government in terms of increasing the collection from divestment. So if they show a very high amount of divestment, they can possibly show lower than 3.5% fiscal deficit. But at this point of time, we think it would be credible to show 3.5%, because anything lower than that will be difficult. Okay. Even if they show it lower, in the end, they will end up spending. Let's not forget this is the year before elections.
You mean you're expecting a 3.5% fiscal deficit for next year, FY19?
Look, I think there's a possibility that they may show 3.2, 3.3, and then in the end do 3.5. But I think the actual numbers will be known only much later.
Of course.
And so we are not trying to buy that, and we just want to ensure that we want to show a realistic number, what is underlying deficit likely to be.
Okay. Hitendra, how will the fixed income market react to this? What is it prepared mentally for?
My own sense actually is that I think if you look at the statements from senior policy makers and you see their actual behavior ever since this government has come into existence, I think this is one of the very few governments where cabinet ministers have openly spoken about the fact that if the sovereign itself borrows at 7.5%, 8% or whatever, it creates a fairly high cost of capital for everybody else in the system. It also creates a debt trap. I think the finance minister himself has spoken about the intra-generational issues it creates, as in, we, the current generation, want the easy way out, so we borrow hundreds of thousands of crores. Kids born 10 years from now will certainly be born that much more in indebtedness. So my sense, based on the readings, based on even what they have done just in the last 2 weeks or so, trying to squeeze out expenditure, trying to do higher amount of disinvestment, is that I think the commitment, both political and economic, to stick to the fiscal deficit glide path that they have set is very much going to be their base case trial. Now, the direct tax revenue numbers thus far are holding up quite better. GST is obviously the unknown, but if I had to pick a number, I think it'll be very close to the glide path number, which is 3%, as we all know.
If the number on the table were 3.1, fixed income markets would be happy. You think you could see the 10-year contained at 7.4, 7.45?
The fixed income market, I think, is no longer in a situation where it is happy about anything, unfortunately. So it'll be relieved if it's closer to the number that I mentioned or the one you mentioned, which is 3.1. On the other hand, if it is the number that Chetan mentions, and given the mood and sentiment, which I'm sure we can talk about later, I think the reaction, it'll be a disproportionate reaction on the negative side.
Okay. Well, Sonal, what do you think the government will do? I mean, what they should do, we can go on and on. What do you think is most likely?
Well, our expectation is actually somewhere between what Chetan and Hitsendra, are expecting. So our expectation is that for FY19, they'll pencil in a 3.2% of GDP. Yes, the political compulsions are there, but there are a few things to also keep in mind. One is that with the cyclical recovery expected to come through next year, actually tax buoyancy will be much better. Second, GST has led to cash flow mismatches in FY18, and that's one of the main reasons, apart from the fact that the expenditure patterns were front-loaded, on why we are facing the fiscal stress for FY18. Given the tax compliance increase that's going to kick in because of GST, e-way bill, etc. coming in, actually GST collection should also pick up in FY19. Third, the spending on programs like infrastructure, etc., can still be carried out by sort of complementing it or supplementing it with borrowing through outside budgetary resources. So you can have, government companies raise money and fund capex. It does not need to suffer. And fourth, in terms of providing the right sort of stimulus to rural areas, to address the issue of farm distress, the government can enact policies that are sort of have both positive political and economic benefits. So you can have, crop insurance, scheme, more allocation towards the employment guarantee scheme, or there can be measures outside the budget as well. For instance, we've seen a number of trade policy measures in order to support, prices of sugar, wheat, edible oil, etc. So all these policies, the fiscal impact is fairly minimal. It does lead to, food inflation being a little higher than what it was in FY18 because the government would try to keep farm prices a bit, more supported into an election year. But the fiscal implications don't have to be that disastrous. So I think, I would sort of say that, the focus on fiscal consolidation should continue and they should be able to actually show a credible number, given the tax buoyancy and other sources of financing that will also be available.
Further questions as to what is a credible tax growth number to take, as well what are off-balance sheet, money raising that the government can do. All those questions to my panel of guests in just a minute. We have to take a break. We are back in a jiffy.